Welcome everyone. It is so great to have you here today for our first Accounting Need to Know webinar. I'm Karis and I'm joined by Gali, and together we're going to lead you through this accounting standards update. So for those not overly familiar with the XRB, we enable high quality, credible and integrated reporting through the provision of robust frameworks and standards. We're responsible for developing and issuing accounting, audit, assurance and climate-related disclosure standards. But today we're focusing on the accounting side of things. So in the accounting team, we support the XRB in achieving its vision by working with the Accounting Standards Board to develop and issue accounting standards. Before we begin, I'd like to jump to a polling question so that we can learn a little bit about who's listening today. So I'll just open that up for you. So that should have just launched now. So pick the one that best describes your background. So it's looking like we've mainly got preparers and then auditors and a few regulators, academics and users of financial statements, and probably some other people who don't identify with one of these. Okay, so here's what we'll be covering today. It's great to have such a wide range of backgrounds on the call, and I hope each of you can take something away from today. You'll see on the slide that we are going to be covering a lot of topics. The purpose of this session is to make you aware of what's happening in the accounting space, and so then you'll know if there are areas of interest for you to go and look into in more detail afterwards. Just a few housekeeping items before we begin. We will be making these slides available to you afterwards, and in some areas we've added links so then you can easily access that additional information if there are areas you want more info on. We will be taking time for questions at the end, but please do feel free to submit questions at any time throughout the webinar via the chat. Anthony Heffernan, who's the Director of Accounting Standards, will respond to questions as they come in, if they're ones that require short answers. And then he'll be making a guest appearance at the end to talk through any of the more substantial ones with me. So thanks for that, Anthony. And then finally, please do be aware that the views presented today are the personal views of myself, Gali and Anthony, and don't necessarily represent those of the XRB. So let's get started with the standard setting environment update. The New Zealand Accounting Standards Framework is split between for-profit entities and public benefit entities. Today, we're just talking about for-profit entities. If you are also interested in public benefit entities, you're welcome to join us for that webinar tomorrow. As a recap, for-profit entities that have a legislative requirement or otherwise choose to report in accordance with standards issued by the XRB follow NZ-IFRS. If they're in Tier 1, that is full NZ-IFRS, and if they're in Tier 2, they have reduced disclosure concessions. So where are we at right now? Taking a helicopter view, we're in a period of calm due to the maturity of IFRS accounting standards. In recent years, IFRS 9, financial instruments, 15, revenue from contracts with customers, and 16, leases were implemented, which was a really busy time. But now that these have been in place for a little bit, the IASB is, or soon will be, conducting post-implementation reviews of these standards. There's been a recent increased focus on supporting consistent application, and you'll have seen this by the activities of the IFRS Interpretations Committee, which we'll discuss in more detail a little bit later. While we are in this kind of period of calm, that being said, there are still some major projects which are in progress or on the horizon, like primary financial statements and some disclosure initiatives. So you might be wondering what this IASB context means for the XRB. So our work plan in the space is largely driven by the IASB's work plan. But we're always looking forwards towards areas where New Zealand should seek to influence international standard setting through submissions or research. And research areas that we're currently looking into are around materiality and intangibles. In addition to this international context, we do also take on domestic projects when they're needed, with the current example being disclosures of fees paid to audit firms, which we'll be talking about in more detail later on. And we also support consistent application by issuing staff guidance when it's appropriate to do so. So with that context of our standard setting environment, Gali is now going to take us through new accounting standards and amendments. Thank you, Gali.
Thank you, Karis, and hi everyone, good to see you. The next few slides focus on the standards and amendments for for-profit entities, which have become mandatory this year or are about to become mandatory in the near future. In the interest of time, I won't discuss each of these amendments in detail today, but I suggest that you have a look at these slides after the presentation and check if any of the amendments might be applicable to your organization. Also, if you are in Tier 1, these slides might be helpful when you are drafting your standards issued, not yet effective disclosure note for your financial statements. So this slide covers amendments that are effective for June 2022 year ends if you're still busy preparing your financial statements for that reporting period. So firstly, we've got the extension of the previous amendment on COVID-19 related rent concessions. So as a reminder, the original amendment introduced a practical expedient for lessees to offer relief when accounting for rent concessions relating to COVID-19. So if you're a lessee and you receive the rent concession because of COVID-19, like a rent holiday, then under that amendment, you don't need to go through and consider if these concessions count as lease modifications for the purpose of IFRS 16. And this means that you don't need to apply the lease modification requirements in IFRS 16, which would otherwise require you to remeasure the lease liability with an updated discount rate. Originally, this amendment applied to rent concessions for lease payments that would have been due by 30 June 2021, but subsequently the ISB extended this to concessions for lease payments that would have been due up to 30 June 2022. Moving on to interest rate benchmark reforms. This amendment has to do with the global phasing out of interest rate benchmarks like the interbank offered rate or IBOR. If your organization is affected by the phasing out of IBOR, then these amendments offer you some practical expedients. For example, the amendments allow you to continue to do hedge accounting if the interest rate on the instrument involved in the hedge changes because of the replacement of IBOR. Also, the amendments allow treating the replacement of IBOR as a change in the effective interest rate rather than having to derecognize and re-recognize the affected financial asset or liability. This slide looks at amendments of for-profit standards that are mandatory for December 2022 year ends and also March 2023 and June 2023 year ends. There's some annual improvements to NZ IFRS. These are narrow scope amendments, which I won't go into now. Onerous contracts, cost of fulfilling a contract. These amendments specify which costs are included in calculating the cost of fulfilling a contract, which in turn is used for determining whether a contract is onerous. This is important because if a contract is considered onerous, then a provision liability needs to be recognized for that contract. The amendments clarify that the cost of fulfilling a contract are the costs that relate directly to the contract. This includes costs that are includes the incremental costs of fulfilling that contract, for example, direct labor and direct material costs. And it also includes an allocation of other costs that relate directly to fulfilling contracts. For example, an allocation of the depreciation charge for an item of property, plant, and equipment used in fulfilling that contract, among others. Looking at property, plant, and equipment proceeds before intended use now. This amendment clarifies that if you earn revenue from selling items produced by your PP&E asset before that asset is ready for its intended use, you can't deduct the sales proceeds from the cost of the PP&E asset. For example, this could apply in the oil and gas industry when selling oil from a testing well before production starts. These slides cover the new standards and amendments that will become mandatory for December 2023 year ends and March and June 24 year ends. If your organization is an insurer or if you issue insurance contracts, then the big ticket item for you on this slide is, of course, the new insurance standard into the IFRS 17 insurance contracts and the related amendments to that standard. I would imagine that most insurers are already well on their way and preparing to apply this new standard. Then we have disclosure of accounting policies. These amendments clarify that entities should disclose the material accounting policies, whereas the previous requirements refer to significant accounting policies. The amendments also add some guidance on identifying which accounting policies are material. Then we have the definition of accounting estimates. These amendments clarify the difference between changes in accounting estimates, which are applied prospectively from the date of the change, versus changes in accounting policies, which are usually applied retrospectively. So a change in accounting estimates, for example, would be a change in inputs used to determine fair value or a change in the fair value measurement technique. An example of a change in accounting policies could be switching from the cost model to the revaluation model, say for PP&E, for example. So looking at an example, let's say I have an investment property, and for the past few years, I have measured the investment property at fair value using the income approach. In other words, I have determined fair value based on market rentals for similar properties. This year, circumstances have changed so that I think it would be more relevant to measure the fair value of the investment property using the market approach. So for example, using recent selling prices of similar properties. This change in the fair value measurement technique would be a change in estimates, and the amendment that I mentioned would help me understand that this is the case. So being a change in estimates, it would be applied prospectively. So in other words, I would not need to go back and calculate what previous year's fair values would have been if I had used the market approach technique in previous years. And on the next slide, we are still looking at amendments for December 2023 and March 2024 and June 2024 year ends. There is an amendment relating to deferred tax. And before I describe this amendment, just a reminder that under IAS 12 income taxes, temporary differences arise when there is a difference between the amount at which the asset is recognized for accounting purposes and the tax base of the asset. Usually, entities need to recognize deferred tax in relation to temporary differences, but there is an exemption from recognizing deferred tax on temporary differences that arise upon the initial recognition of an asset or liability, assuming that certain conditions are met. This amendment on the slide narrows the scope of this initial recognition exemption so that the exemption does not apply to transactions that give rise to an equal taxable and deductible temporary differences. This applies to transactions that give rise to an asset and a liability at the same time, like entering into a lease agreement, which leads to the recognition of a right of use asset and a lease liability. Going with this leases example, the amendments clarify that when you enter into a lease, you need to determine if a temporary difference arises in relation to the right of use asset and the lease liability. And if the answer is yes, and the temporary differences are the same, you then need to recognize deferred tax on the temporary differences arising from the right of use asset and the lease liability, respectively. So it is worth looking at how you currently account for deferred tax on leases and also on other assets and liabilities that arise from a single transaction, like restoration provisions that get capitalized into the cost of PP&E, and checking if your current practice is aligned with the amendment mentioned on this slide. And finally, we have classification of liabilities as current and non-current. or non-current. These amendments were issued originally in 2020, and they aim to clarify when a liability is classified as current or non-current on the balance sheet. The amendments specified that for a liability to be non-current, you must have the right to defer settlement for at least 12 months from year-end, and you must have that right at year-end. Those 2020 amendments also said that if the right to defer settlement depends on complying with covenants, the liability would be non-current only if the entity complies with the covenant as at year-end. Now, this last requirement about covenants gave rise to some application challenges and questions recently. For example, suppose you have a loan repayable in 5 years' time, but the bank can request immediate payment if you don't meet a certain debt-to-equity ratio. And you have to meet this ratio on the 30th of June each year for the next 5 years. But what if you have a 31 December year end? And what if, as of 31 December this year, you actually don't meet the debt to equity ratio as per the bank covenant? But as I said, the bank requires the covenant to be met on the 30th of June, and you expect that by 30th of June, you will meet the covenant. So in this situation, does that mean that your liability becomes current on 31 December? And if the answer is yes, this really makes sense. So the ISB has been receiving questions and concerns on this topic, and they have decided to propose amendments to the original amendments that I mentioned about the classification of liabilities as current or non-current. So if these follow-up amendments are finalized as drafted, they will make it clear that only covenants with which the entity has to comply at year-end affect the classification of an asset as current or non-current. But if a liability classified as non-current is subject to a covenant where compliance is required at future date after year-end, the ISB is proposing to require additional disclosures on those liabilities. So I think the key message for this amendment is to watch the space for the ISB's follow-up amendment in relation to covenants. And also this follow-up amendment is expected to be issued soon. And when it does, it's likely that it will extend the effective date, the mandatory date for application from 2023 to 2024. So if you are thinking about applying this amendment early, the classification of liabilities as current or non-current, it's worth remembering that a follow-up amendment is coming up soon. And I will now hand back to Karis to talk about the IFRS Interpretations Committee.
Thanks, Gali. That was a great whistle-stop tour through new standards and amendments, which I'm sure are relevant to many people on the call. So we are now going to talk about the IFRS Interpretations Committee and some recent agenda decisions. Before we go through the recent agenda decisions, it is just worth us pausing for a moment to talk about what the IFRS Interpretations Committee does and why it's important to keep on top of what they're doing. So the IFRS Interpretations Committee, also referred to as IFRIC, the Interpretations Committee, or sometimes in context just as the committee, and you'll probably hear me use all those terms interchangeably. What they do is their main activity is to discuss application questions about IFRS accounting standards from stakeholders, and then they decide how to respond to those questions. Often the Interpretations Committee responds to a stakeholder's question by publishing an agenda decision with explanatory material. In such cases, the Interpretations Committee has concluded that the principles and requirements in IFRS accounting standards provide an adequate basis for companies to determine their accounting, so standard setting activity is not needed. In other cases, the Interpretations Committee concludes that responding to a question requires adding to or changing IFRS accounting standards by means of an IFRIC interpretation or a narrow scope amendment. Or in some cases, they might recommend that the ISB considers a broader scope project. So why do we need to care about these agenda decisions from the Interpretations Committee? Well, because they don't change the requirements in IFRS, but rather they show us how to apply these standards for a specific fact pattern, they might provide new information on application. So if your existing practice differs from that described in an agenda decision, you're expected to change your accounting policy to align with the agenda decision. This ultimately results in greater consistency of application around the world. Because agenda decisions aren't changing the requirements of existing standards, they don't have an effective date like a new standard would. Instead, entities are allowed sufficient time to implement any changes required. Sufficient time is not a defined term, so it will differ for each entity and for each agenda decision, depending on the circumstances, such as the extent of the changes required to you. So agenda decisions can be quite detailed, and there have been a number issued in recent months. So rather than trying to explain a number of them, I'm going to let you pick what I talk about today. So I'll open our next polling question and you can choose which of these you'd like to hear about. And I'll talk to the top one or two, depending on which ones are selected, because some of them are quite a bit longer than others. Just open that poll. No, it's a bit of a mix. The wind farm is getting more votes than I thought it would. I thought that would be quite a lot less interest. It is still sitting at the bottom. So if you have votes for wind farm, you can get those in. At the moment, the principal versus agent software resellers just beating out negative low emission vehicle credits. Okay, I'm going to end there. So principal versus agent software reseller. This is the longest one, so I am just going to do that one. And bear with me while I work through the fact pattern on it, because it takes a little bit to set it all out. So the committee was asked whether a reseller of software licenses is a principal or agent for the purpose of applying IFRS 15 revenue from contracts with customers. So I'll walk us through a summarised fact pattern of the request. It's a little bit to get our heads around. So there's a distribution agreement between the reseller and the software manufacturer, and that gives the reseller the right to sell the manufacturer's standard software licenses to customers. The reseller's got discretion to price those software licenses, and before selling software licenses to a customer, the reseller needs to provide the customer with pre-sales advice so that they can identify the type and the number of licenses that would meet the customer's need. If the customer decides to purchase the software licenses, then the reseller will negotiate the selling price with the customer. They'll go and they'll order the software licenses from the manufacturer on the customer's behalf. They will pay the manufacturer, and then they will invoice the customer for the agreed price. Then the software manufacturer provides the customer with the software licenses. The software manufacturer and the customer enter into an agreement specifying the customer's right to use the software and a warranty covering the software's functionality and the term of the license. A few points to note. So if the reseller advises the customer to order an incorrect number or type of software licenses, then the customer can choose not to accept them. The reseller can't return these unaccepted licenses to the software manufacturer or sell them to another customer. If the customer decides to buy no software licenses, the customer pays nothing. The reseller and the customer do not enter into an agreement in that case. So that's the fact pattern. Now we'll walk through what the committee said. So the committee noted that determining whether the reseller in the above scenario is a principal or an agent under IFRS 15 will depend on two things. The first is identifying the specified goods or services to be provided to the customer. And the second is assessing whether the reseller controls these goods or services before they're transferred. So on that first point, the identification of the specified goods or services, the committee noted that the software licenses are the only promised good or services in the reseller's contract with the customer. And because they're the only promised good or services, then they are distinct goods to be provided. At the time of entering into the contract, you might be thinking about this pre-sales advice. So the reseller had already provided that pre-sale advice. And so there was no valid expectation of the customer that the reseller would transfer a good or service relating to that pre-sales advice. So the only thing they're transferring is that standard software license. And then on the second point about control, so whether the reseller obtains control over the software licenses before they're transferred to the customer, the committee noted that concluding on this matter requires judgment and would depend on the specific facts and circumstances, which I'm sure is a phrase you've heard many times relating to IFRS 15. And in this case, it would include the terms and conditions of the contracts between the reseller and the customer, the reseller and the software manufacturer, and the software manufacturer and the customer. So a lot of factors to consider. If, after applying the principles and requirements of control in IFRS 15, it's unclear whether the reseller is a principal or agent, then the reseller would go through the steps of considering the indicators in paragraph B37 of IFRS 15 to assess whether it obtains control of the standard software licenses before they're transferred to their customer. So those indicators are around things like inventory risk, the discretion of setting the price, and responsibility for fulfilling the promise. But you only get to that point if it was unclear from applying the rest of the principles. So their overall summary was that no standard setting activity is required. IFRS 15 is clear enough on its own for them to answer this question. And so they've published a final agenda decision on this. So the other thing I did want to make you aware of is a tentative agenda decision, which is this one about cash received via electronic transfer as settlement for a financial asset. So there was a question considered by the committee, and it relates to receivables and timing of cash. So the debtor initiates an electronic transfer on the entity's balance date, but that transfer takes 3 days to complete. So the cash is deposited in the entity's bank account 3 days after balance date. The committee was asked whether the entity recognises the cash and de-recognises the related trade receivable when the transfer is initiated or when the transfer is complete. The committee's tentative agenda decision noted that under the requirements of IFRS 9, cash is recognised when it's deposited in the entity's bank account, not before. Only then does the entity have the right to obtain that cash from the bank. The committee also noted that the trade receivable is de-recognised only when the entity's contractual right to the cash flows from the receivable expires. So the committee has agreed to finalise this agenda decision subject to the IASB's confirmation, which is going to be sought in September. And it was noted that while the agenda decision might cause a change in practice in some jurisdictions, the decision reflects existing requirements in IFRS accounting standards. You might want to look into the timing of when you recognise cash and de-recognise your trade receivables to see if your existing practice lines up with this tentative agenda decision. So Garli's now going to take us through proposals which are open for comment. Thanks, Garli.
Thanks, Karis. So in the next couple of slides, I'd like to draw your attention to recent proposals that we are currently consulting on and where we're very interested in receiving your feedback. We have recently published proposals to enhance the disclosure requirements around fees incurred by a reporting entity for services provided by the entity's auditor or by the reviewer of the financial statements. As you know, there are already requirements in NZFRS 44 to disclose fees paid to auditors for the audit and also for other services provided by the auditor. But we have been hearing calls to enhance these disclosure requirements with a view to improve transparency and consistency around the information provided in financial statements about the services provided to the entity by its financial statements auditor or reviewer and the fees paid for these services. And this improvement in transparency and consistency is exactly what our proposals aim to achieve. The proposed disclosure requirements are intended to help users of financial statements to assess the extent to which non-audit services have been provided by the entity's audit or review firm in the reporting period. I should note that the proposed disclosure requirements don't say what type of services an auditor can or can't provide, but they just require disclosures about the services provided to the entity by the audit or review firms and the fees paid for these services. And as you can see, the proposed amendments would apply to both for-profit entities and public benefit entities. Now, this slide has a bit more detail on what we are proposing. So we're proposing specific requirements to disclose the fees incurred by the reporting entity for services received from each audit or review firm separately for the audit or review of the financial statements, and for each type of other services performed by the entity's audit or review firm during the reporting period. In terms of these other services, we're proposing 4 disclosure categories or buckets. One is for audit or review related services. Another is for other assurance services. Then there is taxation services. And if the service doesn't fit into any of those 3 buckets, then it would go into other services. For each of these buckets or categories, an entity would need to provide descriptions of each service received and the corresponding fee incurred. Also, for Tier 1 entities, there would be additional disclosure requirements around mitigating possible threats to auditor or reviewer independence when fees are incurred for taxation services or for other services. If you want to learn more about the proposals, please visit our website, and there's a link on the slide. Through this link, you can download the exposure draft, which contains the proposals, and also the accompanying consultation document, which has some specific questions for you to have a look at. And you can also electronically send us your comments through that same page. Comments close on the 30th of September, which is not too far away now. And we are keen to hear your views about the proposed disclosures to check if what we're proposing will improve transparency and consistent disclosures around fees paid to audit firms. And I'll now hand back to Karis to talk about XRB staff guidance.
Thanks, Carly. So we've recently issued some guidance on the ongoing accounting requirements for lessees applying NZ IFRS 16. Its purpose is to help you identify when you might need to undertake analysis or make updates to your accounting treatment, such as when you enter into new leases and modify or terminate existing leases. It's really important to remember that the accounting for leases under NZ IFRS 16 is not a set and forget process. There are so many factors that you need to consider at each reporting cycle. So if you need a refresh on any of those, then you might find this guide useful. Looking forward, we're also going to be looking to issue guidance in coming months to clarify how to apply the definition of public accountability in XRB A1. We're not changing the definition at all. This is just clarification of how you apply that. So public accountability is a key element in determining an entity's reporting tier. So for a for-profit entity with public accountability, that entity is required to apply Tier 1 reporting requirements, regardless of its size. There's an important New Zealand nuance around brokers or dealers to be aware of, and we're trying to highlight this part in the guidance. So XRB A1 says that most security brokers and dealers would meet the public accountability criterion. But in New Zealand, many entities that are known as brokers or dealers don't actually hold client assets in a fiduciary capacity, but instead they mainly provide investment portfolio advice or perhaps transactional services. Therefore, judgment is required when determining whether these types of entities meet the public accountability criterion. So this will be coming out in a little bit. If you receive our accounting alerts or follow us on LinkedIn, then you'll see when it gets issued. And then finally, around climate-related risks. So climate change and the impact on a reporting entity's cash flows, financial position, and performance is receiving increased attention from investors, auditors, regulators, and other stakeholders. You may have seen the recent FMA guidance on climate-related matters in financial reporting in their document, which is the approach to oversight of financial statements. NZ IFRS doesn't refer explicitly anywhere to climate-related matters. However, reporting entities are expected to consider climate-related matters in applying the requirements of accounting standards when the effect of those matters is material in the context of their financial statements taken as a whole. Climate-related matters have the potential to impact many areas of an entity's financial statements, and just a few examples of those are listed on the slide. You can also refer to the linked guidance for further examples. We are really conscious that New Zealand entities who will in the future apply the climate-related disclosures here, that you may have questions on if and how these standards might interact with financial reporting requirements, and we're working on guidance with this New Zealand context in mind. So Gali is now going to take us through what else is on the horizon.
Thanks, Karis. In the next group of slides, we are looking ahead to the future at developments that might change accounting standards. As Karis mentioned at the start, our NZ IFRS standards for for-profit entities are based on the IFRS accounting standards issued by the International Accounting Standards Board, or the IASB. The IASB has several large projects on the go at the moment, which, when they're finalized, might ultimately result in changes to our NZ IFRS standards for for-profit entities. For example, the IASB has a project about the presentation of financial statements, which might change the way entities present a statement of profit or loss. The next step of this project is to issue a new accounting standard on the presentation of the face financial statements, but the expected date for this has not yet been identified. The IASB has been redeliberating the proposals based on the comments that they received. The IASB also has been looking at how it sets disclosure requirements in standards. They had issued proposals to focus more on disclosure objectives rather than requiring lists of specific items to be disclosed. It is fair to say, though, that the IASB had some concerns about these proposals, including from New Zealand. So the IASB is now reconsidering what to do in this area of disclosure requirements. The IASB also has a project on goodwill and impairment. As part of this project, the IASB has proposed to introduce disclosures about the performance of business acquisitions. In other words, how successful the acquisition has been against the original objectives that management had in mind when they made the decision to acquire the business. But I think what the million-dollar question of this project is whether the IASB will end up reintroducing goodwill amortization or not. And we will need to watch this space to know the answer. Looking at subsidiaries without public accountability, this is the IASB's project to develop reduced disclosure requirements. As you know, in New Zealand, we develop reduced disclosure requirements, or sometimes known as RDR concessions, for for-profit entities and Tier 2. So we are watching this IASB project with interest because we could possibly use the standard that the IASB ultimately issues as a basis for possibly updating the way we set Tier 2 RDR concessions. I should mention that while the IASB's project focuses on subsidiaries that don't have public accountability, in New Zealand, it is not only subsidiaries that report under Tier 2 with RDR concessions. Another group of international projects on the horizon is the IASB's post-implementation reviews, or PIRs. The IASB normally starts a post-implementation review of an accounting standard after that standard has been implemented for 2 years internationally. A post-implementation review would usually check if the standard is operating as intended and whether there are any application challenges or unintended consequences that might require amendments to the standard. As Karis mentioned, the past few years, 2018 and 2019, saw the implementation of 3 new major standards, being IFRS 9 financial instruments, IFRS 15 revenue from contracts with customers, and IFRS 16 leases. And now the IASB is thinking about the post-implementation reviews of these standards. In fact, the IASB already started the post-implementation review of IFRS 9 last year. The first phase of this review was looking at the classification and measurement requirements in IFRS 9. In other words, the requirements that determine if your financial asset is classified and measured at amortized cost, or at fair value through P&L, or at fair value through other comprehensive income. As part of this review, so far this part of the review resulted in a new project which involves developing proposals to clarify the application of what is known as the SPPI test, or solely payments of principal and interest test in IFRS 9. And there's also a research project in the pipeline about the amortized cost method, but this one, as far as I know, has not started yet. There are two more phases to the post-implementation review of IFRS 9. One will focus on the impairment of financial assets, which includes determining the doubtful debts allowance for receivables and also provisioning for loans advanced to others. And then the last phase will focus on hedge accounting. Then looking further to the horizon, the IASB is also starting to think about the post-implementation reviews of IFRS 15 on revenue and IFRS 16 on leases. Now, you might remember from last year that the IASB consulted on its work plan for the next 5 years, and that we also consulted here in New Zealand on the same question. The most common project recommendations suggested to the IASB by respondents around the world included projects on climate-related risks, cryptocurrencies, going concern, intangible assets, and the statement of cash flows. After considering the feedback received, the IASB decided to add to its work plan for the next 5 years projects on intangible assets, the statement of cash flows, and climate-related risks. Also, the IASB decided that if additional capacity becomes available over the next 5 years, they will also start projects on operating segments and polluting price mechanisms, which include emission trading schemes. At this stage, cryptocurrencies and going concern disclosures did not make it onto the IASB's work plan for the next 5 years. And I have to say that we were quite excited to hear that the IASB decided to undertake a project on intangibles. And as we noted in our comment letter to the IASB, and as we have heard from stakeholders here in New Zealand, the intangible asset standard, IAS 38, is relatively old now, and it has not kept up to date with recent developments in the area of intangible assets. Given the importance of intangibles in our modern economy, it's important to make sure that accounting requirements for intangible assets are fit for purpose. As Karis mentioned, we are trying to contribute to the international process for developing updated requirements on intangibles by encouraging research here in New Zealand on this topic. And I will pass over to Karis now for concluding remarks and questions.
Thanks, Gali. So we had a few questions come in. If you've got any more questions coming to mind, now is the time to send them through the chat. So a couple of questions around IFRS 16. One was a question about whether there's any guidance relating to how you consider onerous leases now that it's different. So I guess as a recap, before IFRS 16 came in, you used to have to consider whether any leases have become onerous. That concept has really gone away with IFRS 16, and instead we're testing our right of use assets for impairment under IAS 36. The staff guidance document that I mentioned earlier does have a section on it about impairment and some of those kind of tricky things that you need to consider. So have a look at that and see if it is helpful. And then there's also a question about whether we canvass users to see how many members effectively opt out of IFRS 16 leases for banking covenants or valuation purposes. That's not really a question I can answer, but I would highlight that the post-implementation review of IFRS 16 will be kicking off shortly, and that is where those sorts of feedback and uses will come in. So we will watch the space and see what the post-implementation review shows us. There's also a question about the cash received by electronic transfer and whether trade date accounting would apply. And because I'd said that you'd recognised cash only when you received it rather than when it was initiated. So in this case, there's not, trade date accounting is not going to apply because there's not, you're not selling a financial asset. And so it's very specific in IFRS 9 when your trade date accounting is allowed to be used. Also a question about research on intangibles. And so that is just at a very early stage of trying to figure out what research would be useful to add to the international discussion to bring in a New Zealand perspective. We will be looking to add to put out a call for research for the ISB's upcoming research forum on intangibles, and they have highlighted particular areas that they are interested in. One of those is around internally generated intangibles, and this is an area that we have a lot of in New Zealand, so perhaps some research in New Zealand might focus around that, but we're still very much working on what that should look like. But if you have any ideas, please do send them in to us. We'd love to hear your thoughts on that. Just while a few more questions are coming in, and to give you a chance to submit those, I will just go to our last polling question. So because this is the first in our Need to Know series, we'd really like your feedback so that we can further tailor these sessions next time. So if there's one of these topics that you'd really like us to get into more details on next time, if you could let us know here, that would be great. There will also be a post-webinar survey coming your way, and so we would really appreciate it if you take the time to tell us what you thought. That would be awesome. So I'll just open this polling question. While that polling question's going, I see there's been a question come in about disclosure of fees paid to audit firms. And the question is, if a different firm is used for tax, does that need to be disclosed separately? So no, so this is just about the fee. So if you've got your auditor and then they're also providing you with other services, this is just disclosure about those additional fees as well as the audit fees that you're paying to your audit firm, not to completely separate firms that do other consulting services for you. Thanks for that poll. Looks like next time you'd like to hear a lot more detail around new accounting standards and amendments. So we'll take that feedback on board for next time. Thank you. Okay, a couple more questions. There is one on, is there any guidance on the impact of IFRS 17 on captive insurers? I'm not sure about that. Garly or Anthony, if either of you have any thoughts. If not, we might need to get back to you on that one. And then perhaps Anthony might bring you in for another question on fees paid to auditors. And this is where the other assurance services would include compilation in alignment with its definition.
I'd have to go back to the definition of a compilation. It feels like it would fall under other services, but other assurance services, if it fits the definition of assurance service, And generally, when you're providing some kind of an opinion over information, where a compilation is the preparation of information. So it's a really good example. And what we're looking for in that feedback on that ED on fees paid to audit firms is really other examples. Within the ED, we've already got examples, and we're very welcome to more. The more examples, of course, the easier it will be. Every time we introduce categories, boxes of where to put different types of information, that requires judgment, and I appreciate people just want to know what the answer is. I've got an example, where does it go? So the more examples we can get that you can feed through to us, the better. So that compilation, great example, we'll take that away and see if we can add that to the standard. Thank you.
Thanks, Anthony. Also a question about the FASB recently announcing their halt on research into intangibles. I think this was specifically around goodwill, and the question is whether the IASB has responded to this. So I think the IASB and the FASB were reasonably aligned for a period of time, that they were both looking into these projects, but I'm not aware of any response as such from the IASB to the FASB dropping goodwill off. The IASB has their own work plan based on their recent stakeholder work, and so they don't have the same constituents, I guess, as the FASB. And that looks like all of the questions. So thank you very much for joining us today. That is the end of our presentation. If you do want to keep up to date with news about accounting standards, please follow us on LinkedIn, or you can subscribe to our newsletter, or you're very welcome to do both. And thank you very much. We'll look forward to seeing you again next time.